All right, joining us this morning to discuss dividends and stock buybacks is Brent Wilsey of Wilsey Asset Management. Welcome as always, Brent.
Good to be here.
Good to see you as well.
Thank you.
So I've known people who say, well, I won't buy a stock if it doesn't pay dividends. Is that a good way to look at things or not?
Well, yeah, in our portfolio, 9 out of 10 companies we buy pay dividends.
Okay.
And dividends are a good thing to have. And actually going back in history, back to 1930, 40% of the return on your equities comes from dividends. So dividends are a good thing, and people just don't understand them. And I think everyone should own equities. They are really, that's ownership. You can pay dividends, and there's a couple of things we'll talk about today, dividends and buybacks. But on the dividends, I mean, last year, 2022, $564 billion paid on dividends. This year, going to be about $600 billion.
What specifically is a dividend? How does it work? What's related to this?
Sure. A dividend is declared by the board of directors. They say, hey, we've got some great profits here. Let's share those profits with our shareholders in the form of a dividend. And what's great about dividends is they are tax favored. Now, what I mean by that, and we've kind of looked at on the federal side, if you're earning as a joint, as a married couple, up to $100,000, $120,000, your dividends can be tax free for you. So there's a lot of benefits to them that people don't realize. And the other thing too that's great about dividends is they grow over time. We have companies in our portfolio, equities that we bought 10, 15 years ago, at the time a yield of 3%, now yielding 10, 12, maybe 14% because companies increase those dividends as profits go up. So you share the profits, the growing profits of the company. They're a great thing to have.
Yeah, they sure are. Absolutely. Now, what did you say here? Payout ratio, cash flow, and debt.
I'm so glad you asked that question because that's very important because some companies pay out more than they should. And a payout ratio just tells you how much of the earnings is that company using to pay out that dividend. Now, obviously, you're paying out 110% of your earnings to pay that dividend. It's not going to last very long. They got to cut that dividend down the road. We like generally a 50 to 70% payout ratio. It means they have the ability to continue to pay out that dividend and maybe raise it. There's a statement called a cash flow statement, like the income statement balance sheet, that actually shows how much cash flow that company makes to make sure that they have the cash to pay out that dividend. So that's something we look at as well to make sure that company can continue paying out that nice dividend and increase that dividend.
So 9 out of 10 that you say in your portfolio pay dividends.
Yes.
The 1 out of the 10 that doesn't pay dividends, why would that be if it's such a great stock?
It's because that company is a growth company where they're a carpet, tile company is what they're actually doing. So they're taking those profits and as opposed to giving to the shareholders, they're expanding the business. And that's another good question because why are they not paying a dividend? Because they're trying to grow that business. When a business gets at a mature level, they can't grow much more. They say, hey, we've got extra profits, we'll give them to the shareholders. But if not, check to see, are they holding that cash? Maybe future expansion they're trying to do. So it's usually for growth of the company. But again, we do favor companies that pay dividends because they're more mature.
Right. And it seems like that company would be motivated to pay dividends. It would show growth, and it would also bring in more investors.
And also, too, dividend-paying companies generally do better during down markets because they are paying out that cash flow. So that's another thing, too, great about dividend-paying companies. When things go down, they don't go down as much.
Okay. Anything else we need to know?
Well, we want to talk about the stock buybacks because that's a big thing with the president right now. They're taxing now 1% excise tax. They want to increase that to 3 or 4%. They feel it's bad. And Warren Buffett came out and he said that if you don't understand it, you're either economic illiterate or a demagogue, which means that you're trying to do political gain with the ordinary people.
And that's coming from Warren Buffett.
That's coming from Warren Buffett because he said they are not bad for the shareholders. They are not bad for the CEO. What they were actually doing, saying we've got extra money here. If we use that money to buy back our stock, that means there's less hands in the pie. So therefore, the earnings per share will go up, which means the value of that stock will go up. But you do have to check to make sure that there is a reason for doing that. I do not like when companies borrow to buy stock at an expensive price. I mean, the stock's at all-time highs. It's trading at very expensive multiples. That's not a good time to buy the stock. But when their stock goes on sale and we're buying it, I love to see companies buy back their stock because it means there's less people with their hands in the pie. We get a bigger percent of those earnings. It's a positive thing to do, but you got to understand it.
I love that you brought Warren Buffett into the conversation. Love that guy, Oracle of Omaha.
Oh, and he has such great sayings the way he says it. And he's not political. He just says, you don't understand it. And I've said for years, politicians are the worst people when it comes to the economy and investing. They don't know what they're doing, and they try to help people thinking, oh, we're going to get those big bad CEOs and stuff that are taking all the money. No, you're hurting the little guy that has money in his 401k, that has, you know, Tyson Foods or Kraft Heinz. I mean, these great companies. He's hurting those companies because they say, let's buy back stock to help our shareholders. They just don't get it. And I don't know what they think they're going to do about it. But the thing is that companies are there to make profits. And that's why I want everybody to invest in the equities, because long term, everyone can do well. And people get in the short-term game of stocks, that's a losing game. Long term is the best way to go.
All right. We're going to wrap it up. I got to tell you, though, my favorite Warren Buffett quote.
Yes.
He said, I've made $1 million in a day, and I've lost $1 million in a day. Either way, I'm having a hamburger and a Coke for lunch. And that is what he has every day for lunch.
That's what he has every day for lunch.
Every day. All right, thanks. Good stuff, Brent.
You're welcome.